what you need to know when you need it. It's Kevin McCullough Radio.
All right, Kevin McCullough, glad you're with us. And on this Thursday, going to take another step over to the markets today because there's been some activity that was predicted on this show on Monday. And to rejoin us for that conversation is David Fisher, the CEO of Landmark Capital. And David, on Monday, you told us that a series of things were going to happen. And you said it could happen as soon as like Tuesday, you were thinking, but possibly as late as next week. We're in earnings season, so people are reporting earnings on a lot of the corporate side. But it happened almost as soon as possible and fairly exact to the way you described. Walk us through what happened.
Well, I said on your program Monday that earnings are going to come out the next couple of weeks, and if the investors don't like what the numbers are, then they could get skittish and be concerned, and they might want to pull out of the market. It would cause what you call the 10-year yield, something I've been watching diligently, move up beyond what you call the 3% level. It's been at 2.9, 2.98, those levels. It's never touched the 3% since 2014, and that's the magical number mentally, psychology. And what happened is exactly that. Caterpillar's CFO was coming out in an interview on CNBC and said that this is the peak earnings. In other words, the stocks aren't going to make any more, companies aren't going to make any more money in their earnings from here on out. That's how the market interpreted. People said, I don't like that news, and immediately the 10-year yield went above 3%. The Dow dropped 600 points in a matter of minutes. It closed down on 424, ironically 424 points. Huh. So, but something else that's happening with that, that's the psychological number, 3%. The actual technical number is a little bit higher, and we didn't go through that. It's 3.05%, not to get all over everybody's head, but that's what traders look for. If it breaks that number, and I think it will, not in the near future, though. I think we'll do it sometime this year, probably this quarter. Once it does that, then there's a lot of uncertainty that will come to the market, it looks like. So this is all just because of what I've been talking about, the Fed unwinding the balance sheet. There's uncertainty. There's this push-me, pull-you, tug-of-war going on, Kevin, between higher earnings and higher interest rates. And right. The market doesn't like higher interest rates. It's not good for corporations. It makes it more challenging to make money in a higher earning interest rate in a higher interest rate environment for corporations.
I could say that tug of war is a good expression for it. It's a great tension between those two, and when one side gets a little bit ahead, the other side recoils, and that's what you're describing. Now, why is the 10-year yield so significant? I'm curious about that.
Well, there's different years of holding a treasury out there. The longest is 30-year. They talked about actually doing a 50-year because we needed more revenue coming to our country here recently, a year or so ago. But the 10-year is significant because it tells us what's going to happen, what people perceive is going to happen within a decade of the country of America. So they don't. People are not saying there's going to be a calamity in 30 years, but they're saying and here's the key, short-term rates, like a 2-year, has been moving up while the 10-year has not been moving up fast enough, and there's this gap, they call that the yield curve. The gap is getting closer together. We're like less than 0.5%. Some say, and I believe this is to be true, that we're going to get what you call an inversion, where shorter-term notes, a 2-year note, the yield will be higher than a 10-year. When that happens, it's an inversion, and that moves us completely into a recession usually. So I think that's going to happen, unfortunately. Not this year, I don't think that will happen. But we're looking for a recession. I mean, I don't want a recession, but the analysts are saying there's highly likeliness that we will have a recession in 2019, but more likely in 2020. So that's...
Just to be clear, the 10-year yield is where people, when they're getting out of stocks and they don't want to turn money straight into cash, they're dumping it into 10-year yields because they feel it's a safer place to be.
Correct. Exactly that.
So when that goes up, that tells you that the nervousness in the market is legit because people are buying that at such a high rate.
Yeah, but here's the challenge. Bond yields, as they move up inversely to price, so as yields go up in the bond, the 10-year, that means the price of what you're holding is losing money. So if you're holding a 10-year note, you don't want this yield to go above 3%.
Right.
You want it to go back down where it was 2 years ago in very low numbers. The average yield for a 10-year should be around 5%. So we're well below normality, and that was all because the Fed intervened in the Treasury market through quantitative easing back in 2009,
right.
10.
It was all Bush and Obama dealing with the recession and trying to stabilize the economy. Which you and I don't know, we've never discussed it in detail. I always thought it ran a lot of risk for us, and some people say it worked, some people say it didn't. Anyway, David, congratulations on that. And friends, if you want to tap into that insight, David's entire firm is ready to help you every single day. They have their financial survival guide for 2018 still available. You can get one by requesting it through our website or calling them at 844-604-2575.